Goldman Sachs says that it might make sense for competitor JPMorgan to break itself up. But there's more than simple interbank rivalry going on here. JPM's huge size means that it faces a steep capital surcharge from regulators. FT columnist John Gapper backs a split. Why so, John?
I think from a shareholder point of view, which is how Goldman has addressed its analysis, it's a bit of a wash in terms of whether or not it would make sense for JPMorgan to split up. But from a society's point of view, I think it might well be a good idea because large banks, especially gigantic banks like JPMorgan with 240 trillion of assets, are extremely hard to supervise, to understand what's going on inside. And ultimately, if they fail, it causes immense disruption and chaos. So I think there's from the point of view of taxpayers and society as a whole, it would be good if they were simpler.
But it's not really the job of regulators to cut banks down to size so they're easier to regulate. Surely it's the job of the market to decide what size of institution makes sense. For example, there are scale advantages that might reduce charges for customers.
Well, I mean, that's an interesting point. The overt reason for capital standards is to make the financial system more stable, and that's what the Fed has been emphasizing. But there's a secondary motive, which it's also talked about, which is to somehow level the playing field between systemically important banks and medium-sized and large ones. I think that's perfectly legitimate, because if you don't do that, then the scale advantages that you've talked about means that banks such as JPMorgan may well just get bigger and bigger and bigger.
But at a practical level, JPMorgan can presumably deploy an army of corn-fed lobbyists in Washington to avert this kind of thing.
Yes, and it might well have an interesting argument, which is that the Fed appears to be inching towards doing something which the Dodd-Frank Act didn't do, which is to impose a structural remedy to actually divide commercial from investment banking. And since Congress didn't want to do that, some people might say, well, why's the Fed taking that role instead?
And it seems to me that perhaps what all this tells us is that the idea of the universal mega bank is really quite badly damaged.
Yes, it's under a lot of pressure. It's under a lot of pressure from shareholders actually asking whether or not the scale is really worth it. I mean, one of the arguments that Goldman's bank analysts advance is that JPMorgan is trading at a discount, a conglomerate discount, that actually breaking it up makes sense for shareholders on its own terms. Then you have the regulatory push. So I think there's a lot of sense that universal banking, if not dead, is under a lot of pressure.
Might some of this just be cyclical because investment banking has been weaker, particularly in things like fixed income trading in recent months and years?
Some of it might be. JPMorgan actually is not a good example of that. There are other banks like Barclays where the investment banking side has been clearly weaker than the commercial side. Actually, JPMorgan is pretty balanced and it's doing pretty well on all fronts, which is one reason why actually if you want to make it break itself up, you need to impose quite tough capital requirements to force that.
But the sense that regulation is heading in a particular direction against universal banks seems quite strong. So thanks very much for talking us through that, John.